Differentiated banks. Small banks versus payment banks. There are two kind of banking license that are granted by RBI, Universal Bank License and Differentiated Bank License. Differentiated banks are the banks that serve the need of a certain demographic segment of the population. Small finance bank and payment banks are example of differentiated banks in India. Custodian banks and the wholesale and the long-term finance banks are newly proposed differentiated banks. Differentiated banks versus universal bank. Differentiated banks are distinct from universal bank as they are infused as niche segment. Example, commercial bank like SBI, SDFC, ICICI are the example of niche banks. Niche segments typically target a specific banks and tailor the bank's operation to this market's preferences. Differentiation could be on account of capital requirement, scope of activity, area of operation. As such, they offer a limited range of service or products or function under a different regulatory dispensation. Background of small finance bank and payment bank. The concept of differentiated banking is not entirely new. In fact, in a sense, urban cooperative banks and the primary agriculture credit societies, the regional rural banks and local area banks are considered as a differentiated banks as they operate in localized areas. But con- the present concept of differentiated banks can be said as a first discussed in 2007. Thereafter, the concept was once again discussed in the paper Banking Structure in India, The Way Forward, brought by RBI in August 2013. RBI granted in principle approvals to 11 entities for setting up payment banks in August 2015 and 10 for small banks in September 2015. Small financial banks. They are niche banks that focus and serve the need of a certain demographic segment of population. The objective of setting up a small finance bank will be further to financial inclusion. First, the provision of saving vehicle. Second, supply of credit to small business unit and small and marginal farmers, micro and small industry, and unorganized sector entities through high technology and low cost operation. Small Finance Bank (SFBs) was recommended by Nachiket More Committee on Financial Inclusion. Scope of activities in small financial bank. The small finance bank shall primarily undertake basic banking activities of acceptance of deposits and lending to unserved and underserved sections including small business units, small and marginal farmers, micro and small industries and unorganized sector entities. There will not be any restrictions in area of operations of small financial bank. What are the criteria for setting up SFBs? Individual profession with 10 years of experience in finance, NBFCs, microfinance companies, local area banks are eligible to set up small finance banks. The minimum paid up capital equity for small finance banks shall be 100 crores. The promoters minimum initial contribution to the paid up equity capital of such small finance bank shall be at least 40% and gradually brought down to 26% within 12 years from the date of commencement of bank business. The foreign shareholding in small finance bank would be as per our FDI policy for private sector bank as amended from time to time. The small finance bank will require to extend 75% of its adjusted net bank credit to the sectors eligible for classification as priority sector lending by RBI. SFBs have to maintain certain cash reserve ratio (CRR) and statutory liquidity ratio (SLR) as per RBI norms. At least 50% of its loan portfolio should constitute loan and advances up to 25 lakhs. What can small finance bank do? Sell forex to customer, sell mutual funds, insurance and pension, can convert into full-fledged bank. What small finance bank can't do? Extended large loan, cannot float subsidiaries and deal in sophisticated products. What are the challenges to small finance bank? They have to compete with existing PSU banks, RRBs, microfinance institutes, and NBFC are specialized into micro lending operation with limited exposure to banking operation. That means they have to hire, train talent from banking industry. The cost of deposit mobilization will be higher for these banks as they cover rural and underserved segment. Now coming to payment banks. The objective of setting up payment banks will be further to inclusion of providing first small saving account, payments and remittance services to migrant labor workforce, low income household, small businesses, the other unorganized sectors entities and other users. They will not lend customers and will have to deploy their funds in government papers and bank deposit. Scope of activities. Acceptance of demand deposits. Payment banks will initially be restricted to holding maximum of 1 lakh per individual customer. Issuance of ATM and debit cards. Payment banks, however, cannot issue credit cards. Payment and remittance services through various channels. Business correspondent of another bank subject to Reserve Bank guidelines on business correspondent. The distribution of non-risk sharing simple financial products like mutual fund units, insurance product, etc. The payment bank cannot undertake lending activities. Criteria for setting up payment bank are as follows. First, existing non-banking prepaid payment instrument, that is PPI issuers and other entities such as individual professions, NBFC, corporate business correspondent, mobile telephone companies, supermarket chain companies, real estate cooperatives that are owned and controlled by residents, and public sector entities may apply to set up payment bank. Promoter and promoter group should be fit and proper with sound track knowledge of professional experience or run their businesses for at least period of 5 years in order to be eligible to promote payment banks. Minimum paid up capital equity for small banks shall be 100 crores. Maintain minimum 75% deposits in government bond and maximum 25% deposit with scheduled commercial bank. The promoter's initial contribution to paid up equity capital of such payment bank shall be at least 40% of first 5 years from the commencement of his business. The bank should have high-powered customer grievance cell to handle customer complaints. The operations of the bank should be fully network and technological driven from beginning, conforming to generally accepted standards and norms. So what are the things that payment bank can do? Offer internet banking, sell mutual fund, insurance, pension, have bank business correspondent and ATMs, offer bill payment services to customer. They can enable transfer and remittance from mobile phone. They can offer forex service at charges lower than bank. They can provide forex credit to traveler usable as debit or ATM card all over India. They can offer acceptance mechanism to third parties such as Apple Pay. What are the things that payment bank can't do? Offer credit card, extend loans, handle cross-border remittance, accept NRI deposits. What are the challenges for payment bank? Lower revenue, can't undertake any businesses, and the income is initially restricted to charges on remittance and efficiency of operation. Second, they require minimum 75% of its demand deposit balance in government security. This limits the ability to earn from deposit base as well. Banks are already offering most of the service that payment bank can, and hence payment bank to offer new and differentiated proposition will not be easy. Other uh, services such as other saving instruments like Kisan Vikas Patra, gold bonds have better returns than payment banks. Experience from Jan Dhan Yojana has shown that many such no-frill accounts have been remained dormant, thus affecting the viability of the banks. What are the differences between payment banks and small finance bank? Newly proposed differentiated bank, in addition to recent licensed differentiated banks such as payment banks and small finance banks, the Reserve Bank has exploring the possibilities of licensing other differentiated banks such as custodian banks and banking concentrating on wholesale and long-term financing. Custodian banks are specialized financial institutes mainly responsible for safeguarding firms' individual and financial assets and typically not engaged with conventional retail lending. What are wholesale banks? Wholesale banks are lenders that cater to large corporates which require long-term finances, particularly those engaged in infrastructure development. Typically, these banks raise funds which are exempted from maintaining regulatory requirements like CRR and SLR. So, apart from that, the data on payment banks and small finance banks are they are they are niche and differentiated by the common objective of further financing inclusion. Well, India's domestic remittance market is estimated to be 800 to 900 billion and growing. With money transfer made possible through mobile phones, a big chunk of it, especially that of migrant laborers, could shift to this new platform. Payment bank can also play significant role in implementing government direct benefits transfer schemes where subsidies on healthcare education gaps paid are directly to the beneficiary's account. Payment banks have proved popular in other developing countries. In Kenya, the most cited story, Vodafone M-Pesa is used by 2 in 3 of adults to store money, make purchases, and transfer to friends and relatives. Thank you.